A single Federal Reserve decision just sent a message through every corner of the financial world. And if you're holding XRP, Bitcoin, or any crypto asset, you need to pay close attention. On the surface, the Fed simply left interest rates unchanged. But beneath that headline lies a much bigger story that markets immediately reacted to. Bitcoin briefly dropped below $65,000, bond yields climbed, the US dollar strengthened, and investors suddenly began asking a very different question than they were asking just a few weeks ago. Instead of wondering when rate cuts will begin, markets are now debating whether interest rates could stay higher for much longer than expected. And by the end of this report, you'll understand why that shift could have major consequences for XRP, Bitcoin, and the broader crypto market in the months ahead. The Federal Reserve decided to keep its benchmark interest rate unchanged within the range of 3.50% to 3.75%. At first glance, that may sound uneventful. After all, no rate increase and no rate cut usually suggest stability. However, experienced investors know that the Fed's words often matter just as much as its actions. The central bank's latest communication revealed a more cautious attitude toward inflation and economic conditions. Rather than signaling confidence that inflation is moving under control, policymakers emphasized that future decisions will depend heavily on incoming economic data. That may sound technical, but the message was clear. The Fed is not ready to promise easier monetary policy. For investors who were expecting a clearer path toward lower rates, that realization created immediate uncertainty across financial markets. The most significant development came from the Federal Open Market Committee projections. Let me break this down because it's one of the most important details in the entire announcement. 9 out of 18 Federal Reserve officials now expect at least one rate hike during 2026. That's a major shift in expectations. Not long ago, the dominant market narrative centered around potential rate cuts and a gradual easing cycle. Investors were largely focused on when borrowing costs would begin falling. Now, that conversation has changed dramatically. The possibility that rates could remain elevated or even move higher again has entered the discussion. When markets are forced to reprice expectations that quickly, volatility often follows. That's exactly what happened as traders rapidly adjusted positions across stocks, bonds, currencies, and digital assets. The reason behind this shift is inflation. Consumer Price Index inflation remains at 3.75%, showing that price pressures continue to linger in the economy. Inflation has cooled from previous highs, but it has not fallen enough to fully satisfy policymakers. From the Fed's perspective, declaring victory too early could risk allowing inflation to accelerate again. That explains why officials continue emphasizing patience and caution. For investors, this means every major economic report becomes increasingly important. Future inflation readings, employment data, wage growth figures, and consumer spending numbers could all influence expectations about future Fed decisions. Markets are now entering an environment where economic data releases may trigger larger than normal reactions. In other words, volatility could become the new normal for investors navigating both traditional finance and crypto markets. Federal Reserve Chair Kevin Warsh reinforced that message during his remarks. His stance was straightforward. The Fed will follow the data, not market expectations. While that phrase may appear simple, its implications are significant. Investors often look for reassurance that central banks will support markets during periods of weakness. This time, however, the message suggested that policymakers remain focused on controlling inflation first. That means hopes for rapid monetary easing may not be enough to influence policy decisions. Instead, incoming economic numbers will determine the path forward. For financial markets, that creates an environment where certainty becomes harder to find. Traders must now evaluate every new economic report through the lens of how it might affect future interest rate decisions, making market reactions faster and potentially more dramatic. You might be wondering, I hold XRP, why does this matter to me? Here's the connection. Cryptocurrencies, including XRP, Bitcoin, and many other digital assets, often perform best when financial conditions become more supportive. Lower interest rates generally increase liquidity in the system and encourage investors to seek higher return opportunities. When money becomes cheaper to borrow and easier to access, risk assets frequently benefit. However, a Federal Reserve that refuses to commit to rate cuts changes that equation. If rates stay elevated for longer, investors may become more selective about where they place capital. That can create headwinds for speculative assets. While XRP has unique factors influencing its price, including Ripple's business developments and regulatory progress, broader macroeconomic conditions still play a major role in determining overall market sentiment. Markets reacted almost immediately after the announcement. Bond yields moved higher, reflecting expectations that interest rates could remain elevated. At the same time, the US dollar gained strength. Those developments are important because both tend to create pressure for risk-oriented investments. Higher bond yields provide investors with alternative opportunities to earn returns without taking as much risk. A stronger dollar can also tighten financial conditions globally, making liquidity less abundant. Historically, these trends have not been particularly favorable for Bitcoin in the short term. As traders processed the Fed's message, money quickly moved across different asset classes. The result was a noticeable shift in market positioning, demonstrating just how sensitive investors remain to signals coming from the central bank. Bitcoin's reaction became one of the biggest talking points following the decision. The leading cryptocurrency briefly fell below $65,000 before recovering into the mid-$65,000 range. Importantly, this was not a catastrophic breakdown or a major technical collapse. Instead, it served as a reminder of how closely digital assets remain tied to macroeconomic developments. Even in an era where blockchain innovation continues advancing rapidly, Bitcoin still responds to interest rate expectations, inflation data, and Federal Reserve communication. The quick recovery also suggested that buyers remain active, but the move highlighted growing market sensitivity. Investors watching price action closely were reminded that a single economic announcement can trigger substantial swings, even in one of the world's largest and most established digital assets. Now let's focus on a level many traders are monitoring closely. The $65,000 area has become a key zone for Bitcoin. If BTC remains above that level, many market participants may view the recent decline as another temporary macro-driven shakeout, rather than the beginning of a larger downturn. On the other hand, a decisive break below that support could encourage additional selling pressure and potentially lead to deeper losses. This is why upcoming economic reports carry so much weight. Every inflation update and labor market release could influence expectations regarding future Federal Reserve policy, which in turn could impact Bitcoin's ability to maintain important support levels. As investors evaluate the next move, attention is shifting from speculation about rate cuts to careful analysis of economic fundamentals. Despite the immediate market pressure, the story is not entirely negative for crypto. In fact, there is another side to this narrative that long-term investors are watching closely. Persistent inflation can strengthen Bitcoin's appeal as a scarce asset. Many supporters view Bitcoin as a form of digital hard money because its supply is limited. If inflation continues reducing the purchasing power of traditional currencies, some investors may increasingly look toward alternative stores of value. This argument has existed for years within the crypto community, but periods of persistent inflation often bring it back into focus. While short-term volatility may continue, the longer-term investment thesis for Bitcoin could receive renewed attention if inflation remains stubbornly elevated and concerns about currency purchasing power continue growing. For XRP holders specifically, these developments matter because they influence the broader environment in which Ripple and the digital asset market operate. Even when XRP-specific news drives headlines, overall investor sentiment often determines how strongly markets react. A more cautious Federal Reserve can affect liquidity conditions, institutional participation, and risk appetite across the entire crypto sector. That doesn't mean XRP's future depends solely on interest rates. Far from it. Ripple's ecosystem growth, blockchain adoption, regulatory developments, and cross-border payment innovations remain critical factors. However, understanding the macroeconomic backdrop helps investors put daily market movements into perspective. The interaction between monetary policy and digital asset adoption will likely remain one of the most important themes shaping crypto markets throughout the coming years. As we wrap up today's report, the key takeaway is simple. The Federal Reserve held rates steady, but the message behind that decision was far more influential than the rate hold itself. Inflation remains at 3.75%. Policymakers are signaling caution. 9 of 18 officials now anticipate a possible rate hike in 2026, and markets are adjusting to the possibility that interest rates may stay higher for longer. Bitcoin's drop below $65,000 highlighted the market's sensitivity to these developments, while XRP investors are being reminded that macroeconomic trends continue to shape the broader crypto landscape. We'll be watching every major inflation report, jobs update, and Fed signal moving forward. If you found this breakdown valuable, make sure to subscribe to XRP Economic Radar. Like this video, share it with fellow crypto investors, and let us know in the comments whether you believe higher for longer interest rates will slow the crypto market or strengthen Bitcoin's long-term value narrative. Thanks for watching, and we'll see you in the next update.